All right, Biz Brew, good to have you along. 60 million homes strong. We're broadcasting live from the Jump Television Studios in sunny San Diego, California. Risking the broadcast license of every affiliate in this country by having Russ-T-Nailz here.
So if I do this,
or he says,
yeah, that was our last show. Got a little excited.
Yeah, I did. Hey, look at Chase Wilsey is here. Wilsey Asset Management?
Wilsey.
Will you make money?
Wilsey.
That's exactly right. No, they do make money.
They hate that.
They're fantastic what they do. Brent Wilsey is our resident stock spokesperson on the program, and his son Chase, all of 23, you said?
22.
22 years old.
God, you keep aging the kid.
I know. 23 is
I know, that's
getting
like
old.
5% older.
Yeah.
I don't think about
Well,
that.
he's only got 3 minutes left because his mom's out front.
Yeah.
That's how bad it is.
Wow, that's really something. Yeah, so Chase comes in with a briefcase and a Munster's lunchbox. Thank you. Thank you. I'll be here all week. So Chase, last time you were here, you were talking about, and I've got 2 college kids, and they're both big fans of this app called Acorn.
Yeah.
Now Acorn, which I believe I have on my phone, Acorn basically rounds up your purchases and puts it in the bank.
45.50 turns into 46.
Yes, so in other words, right, exactly right.
And they
So they
get
take
the
that
50
50 cents. It's
I
sort of
bet
a forced
that's
savings plan.
Yeah.
Now, is that about right? Is that would that work?
Yeah, the way it works is they do collect, so if you go to the grocery store, you spend $9.50, they'll take that extra 50 cents, put in the Acorn investment app. They'll also ask, oh, you can contribute, more money, you can contribute $100, $1,000 if you want.
Now, let's stop right there, because what do they know? Do they have a good track record? But are they good?
Therein lies the rub, right?
Exactly. And I have 2 major problems with Acorns.
Okay.
And the first one is they're pretty much like a broker. So they'll start you off and they'll take you through, what's your suitability? So they'll take you through all these questions. What's your income? How old are you?
Yeah, by the way, I remember
horizon.
that. So I was over at the cafe with having breakfast with Delaney, and she was setting this thing up. That's a good idea. What the heck?
Yeah.
I mean, these guys, I allot them a certain amount of money every week, and they take part of that, and they put it away themselves.
Yeah.
But they also want to go like, hey, how do I trim my sales there? So yeah, fine, go do that stuff. It was about 30 questions about suitability, and what they're asking is what your risk tolerance is, really.
Exactly. And then what they'll do is they'll take your risk tolerance and put you into one of 5 different groups. They have conservative, moderately conservative, mediocre, I guess, and slightly aggressive and aggressive.
Yeah.
What the hell was I thinking?
Shouldn't you be aggressive at your age overall, or not?
Definitely. And the thing they put me in was the slightly aggressive.
See, and the reason you should be aggressive is because you have a longer time horizon.
Longer
right?
time horizon,
Make up
exactly.
for a couple boo-boos along the way.
Well, because over the course, I mean, they say in the last 5 years, if you'd missed the top 9 days in the market, you would have returned like a 6%. If you were in the market during those times, you got like a 12% return or something like that. So you have to be at risk, is what they're basically saying.
Yeah, risk, but not really risky. I don't invest in risky
Not risky,
assets,
but when I say risk, you have to be your money can't be sitting on the mattress. It can't be in a savings
cash.
account. When I call risk, you have to be investing.
Correct.
Right?
Yeah.
But not risky.
Yeah, that's correct. And the way they do it too, so once they separate it into one of the 5 different brackets, they'll put you into 6 different ETFs based on your bracket.
Okay.
Now the 6 ETFs they have.
Well, wait a second. Before you get there, explain what an ETF is. That's an exchange-traded fund.
Exchange-traded fund. So it's almost like a mutual fund. It's a basket of stocks, but it trades like an individual equity.
Unlike a mutual fund, if you have a
Correct.
mutual fund, which has a fund manager, usually it's a no load fund. If you want to sell that mutual fund, let's say it was trading at 100 at the opening of the day, but it closed at 98, you get the 98.
Oh, that's
with an ETF, it's just like a stock. So if you like, hey, I want to strike at $100, you strike at 100.
Oh, that's a good one.
Yeah, they typically have lower expenses, which is good. One thing that kind of concerned about the ETF was when the market crashed back in August, the S&P ETF was down 30% because people forget it trades like a stock.
Yeah.
So it didn't.
So they've got
trade at the end of
shares
the
in
day.
this SPDR, or this ETF, exchange traded fund, and all of a sudden the market's taking.
Yeah.
They got to have. Now, let me ask you this, because you guys are buy and hold strategists. In other words, you buy a stock and set it and forget it for a little while. I know you guys mind the shop on it.
Yeah.
But do you guys ever put a stop loss in on something, like refuse to lose more than 5% or something like that?
No, we will never use a stop loss. We use limit orders, so we lock in where we'll buy and where we'll sell.
Okay, so explain the difference, because the stop loss, I use a trailing stop because I'm a little more risky than most. In other words, if I buy a stock at $100, and I refuse to lose 5%, if it hits 95, I'm out regardless. However, it's a trailing stop. So if that stock goes to $200, I'm not going to sell at 95. I'm selling at 190. Okay, right? So that's a stop loss. Explain a limit order.
A limit order says, let's say the stock's trading at $65 a share right now. Well, you say, I want to buy the stock at $62 a share. Okay. So you put in a limit order at $62 a share.
So if that thing fades down to 62,
you get the stock at that price of $62 a share.
Okay.
Same thing works if you're selling the stock. If you say it's at 65, you want to sell it at 70, you can put in a limit order at $70.
Yeah. Set it and forget it.
Well, it's the upside downside thing. So in other words, and it's almost I wouldn't say opposite of a stop loss, but the limit order kind of tells you when I'm going to get in, when I'm going to get out.
Exactly.
Now the reason you'd get out at that point is because you're going to take some profits and go back to your cost basis at that point, or do you get out of the stock completely, or does this depend on the stock?
Depending on the stock, and we're very disciplined in our approach. So we have target sells for all of our companies. Prices based on the forward earnings of the company.
Okay, so now let's go back to Acorn, because Acorn
got off topic.
Well, but it was important because because the Acorn thing is interesting because it sort of usurps all of the common sense that you guys put into managing money, and it gives you into one size fit all. That doesn't work.
Yeah, this all sprung from my question: how good are they? If they're keeping your money, we'll invest it. Well, in what? How do I know Acorns are going to not go nuts?
Oh, thank you for that.
Well, I mean, the 6 ETFs they invest in, they have an S&P 500 ETF, a small cap ETF, an emerging markets ETF, a real estate investment trust.
So it's really a broad stroke deal.
They have a lot of different stuff, and that's kind of the thing I have a problem with. And the other ETFs they have are 2 bond fund ETFs. And as you were talking about before, interest rates are going to go up.
Yeah. So there's an inverse relationship between interest rates and bonds. Interest rates go up, bonds go down. So, but wait a second, though. Think about this. Isn't it better than nothing, though, Chase? Isn't it better than doing nothing? All right. Okay, hold on that thought. When we come back from the break, he's going to tell us.
Way to hang.
No, seriously, because here's a person who's advocating millennials to invest money, even a little bit at a time. We should talk about that too and get back from the break.
That is a little bit the Acorn thing. With
it is. See, where I'm sitting, my kids already invest in issues, but I'm thinking the Johnny Lunch Bucket who's never invested, at least it's something. Chase is going to debunk that myth in just a second. His name is Chase Wilsey. He's with Wilsey Asset Management, wilseyassetmanagement.com. Brent Wilsey is typically in here. We kick Brent out. Get the kid in here.
Well, he started cussing, and
Yeah, he doesn't cuss. You cuss at him.
Well, this is the call. This is why his son is here.
All right. Biz Brew, U2America, U2America.com is that website. You can follow us on Twitter, Sully on the Air, or Russ-T-Nailz, or even Radio Coalition or Big Biz Show. There's about 40,000 altogether there. All right, stand by. We're back in a second.
Ow, wow, wait a second, man. What do you think the future's going to look like this year? Whoa! Oh.
That's right, Biz Brew. What's the matter with you?
That was a little chunky.
Biz Brew! U2America, U2America.com, RussIsFunny.com, because RussIsFatandBald.com was already taken by somebody. At Fat and Bald is Russ's Twitter handle, although he would never know how to tweet. Wilsey Asset Management.
There we go.
WilseyAssetManagement.com is their website.
Yeah.
Chase Wilsey, millennial investing expert. Wow, I was tough to say. So we're talking about this Acorns thing, and Acorns is an app whereby you can, if your kids want to start investing, they fill out a suitability standard questionnaire. The app comes up. They, it takes all their spare change. It rounds up
from a credit card, right?
But I mean, if you debit swipe credit card
from a card,
listen, you go buy a Starbucks and it's $3.50. You swipe the card, you round it up to $4.
So they know about your cards? I'm sorry, I don't understand how this works.
Yes.
Yeah. So you type in, I got a Starbucks card.
Yeah, right. They just go like that. That's exactly how it works. So one would say it's better than nothing. Okay.
Yeah.
Now let's take Zach Attack Weekland for example. Zach is 17 years old.
How much you putting away every day, Zach?
So if Zach were to put away, okay, at age, I don't even know if I can go down this low. Age 17 years old, and let's say he's got $100 in the bank. Okay, total. I don't know how much he's got in the bank. Now let's say let's give him a 9% return until he's gonna go at age 70. Let's say Zach could somehow, some way, find $100 a month. That's $25 a week, right?
Yeah.
So that's, what is that? $1,200 a year. Okay, let's put that in. He would have, by the time he was 70, $1,300,000.
He's so gonna quit.
Zach, $25 a week, big fella. That's all you gotta do.
Yeah.
But now, what I would say, is that, and you say the younger you start, the better. Isn't something better than nothing? Or is it too bad of an idea?
Yeah, and as I said, I really like the idea of getting young people to invest. Now, the thing we've learned about investors is they're very emotional. Another thing we know about the millennials, they're very scared of the stock market.
Yeah, because they're staring at that faded hope and change poster on their wall from 8 years ago.
Exactly.
Yeah.
This has a big concern, or this creates a big concern for me because, as I said, the Acorn app is heavily invested in, if you're aggressive, you're investing heavily in emerging markets. Well, emerging markets were down over 25% in the last 6 months. What's the typical investor going to do if they see that? They're going to panic and get out, creating a loss in the portfolio, and then they're going to lose out on that.
Well, because what happens when you sell at the bottom, Russ?
Gotta lock in your losses.
You just lock in your losses.
So, exactly. And kind of a way that we
mitigate that.
Yeah, mitigate that. Fear is we own these small pieces of large companies, and we really understand these companies. Well, what Acorns does, as I said, they're investing in ETFs. Well, the S&P 500 ETF has over 500 companies in it. Those small ETF or small cap ETF has over 1,500 companies. The emerging market ETF has over 1,000 companies in it. So if I don't know what I'm owning, I don't feel comfortable investing in it.
Those ETFs, for a second, they remind me of cable. Like I'm getting stuff I don't even want.
Yeah, it's like a big cable. It's a cable package.
Yeah.
And there's 50 channels you're never going to look at.
Right.
Yeah.
Right. There's 3 you look at a lot though.
Right.
Careful. Can I ask you this? What's the solution here? Because you're telling your friends say, hey, they're trying to go, hey, Chase, look, I got the Acorn app, and they're thinking they're all great. Chase is going to
set
finally
for life. I'll have $1.5 million.
What's the other option? Because look at if Zach had $100 to start off, he's 17 years old. Could he go to a firm like yours and say, I got $100, want to put stuff away?
Yeah, well, we do have a few small accounts, and I'll help out my friends. And if someone wants to call me up and talk to me about it, what I would recommend is actually saving that cash until you have a couple $1,000s.
Okay.
And then once you
put it in a coffee can, put it in the savings account, put it under the mattress, so you got a couple grand.
Yeah, a couple grand. That way you can actually start to build your portfolio and build it with a few good companies in it. And then once you have those few good companies, then you can invest in those and let that grow over time.
Now, do you dollar cost average? Is that how you guys play this game? And dollar cost averaging, by the way, it would be buying the same dollar amount every month of a mutual fund or a stock, regardless if it goes up or down, because at the end of the day, you're dollar cost averaging what that price is. Is that the way you should do that for a kid, or is it just a matter of making sure you put the same amount in with your investment advisor every month?
Exactly, making sure you put the same amount in every month with your advisory. It doesn't necessarily have to be every month. You could do it yearly. We have several clients that contribute yearly, monthly, just kind of whenever you get the money and feel comfortable putting it away. Because worst case too, you don't want to contribute the money and say, I contributed too much, I have to pull it out. Because then what happens is you have to sell out.
Penalties.
That's bad.
I want to make it very clear, by the way, I'm using a retirement calculator online. These are not, Chase and Brent and Wilsey Asset Management is not predicting returns for you. I'm just looking at a retirement calculator and saying, look, this is kind of what the math says based upon inflation and everything else. Really what the illustration says here is that you don't need to put a lot away if you start very young.
Young.
So if parents have kids in college, all right, and now the average college kid's age 20, 21 years old. Okay, are you suggesting that that's what they start doing right away? Is putting money away for retirement?
Definitely, and
Now, did you put money away for retirement, or you put money away for a house?
Well, since I work with my dad, I get a SEP IRA is what he does. I don't want to get too much into that.
No, but the point is though, but if a guy goes in there, you're 25 years old, you're going to buy a house when you're 30. Let's say you get married or you're 28 or 30 years old. The first big purchase of your life is a house. You need a down payment.
Yeah.
Are you saving for that part, or do you keep that? Or do you suggest that they keep things separate?
It's really important to get down to it when that time comes. And right now, I just have a growth account, and that's what I'm contributing to.
Because
when you need the money, you're going to go.
See, because what I would want to do is I wouldn't want to screw up my retirement account, because earlier you start. If you wipe the thing out at age 30, now you're starting over at age 30.
Exactly.
Right? So there's got to be. So there has to be some sort of a solution to do that.
Yeah, and I think it's important to understand, look down the road and say, well, what do I need money for? A house is going to be a big one. Personally, I don't like real estate investment, but there will be a time in my life where I do have a wife and kids, hopefully, and I'll say, okay, I do want to buy a house.
Yeah, we and Russ want to talk to you about that.
I know.
What were you thinking?
50% more wealth.
Yeah, but
can I also? So what do you suggest? By the way, before I let you get out of here today. By the way, Chase Wilsey's his name. He's a millennial investing expert, working for Wilsey Asset Management. WilseyAssetManagement.com. is the website. So you talk about the market running on fear and greed. We lament our losses 3 times more than we celebrate our gains.
Yeah.
Let's face it, the older you get, the more patient you get, you understand the market.
Mm-hmm.
You see these wild fluctuations in stock and you look the other way. That's got to be the toughest thing that you tell your friends. What do you tell these millennials? That you're going to say, look, there's going to be tough times ahead.
Get off the bridge.
But the Dow would be at a negative if overall we didn't make money in the stock market year over year, correct?
Yeah, and one thing I'll tell them is, as I come back to it, that you own a small piece of a large business. Well, you actually own a piece of that business. You know, Apple is a great company. It's going to be there. They're going to continue to sell their iPhones. They're going to continue to innovate. Yeah. You can't look at the stock price day to day. That's when you get.
It's a snapshot in time, right?
Yeah, you get very concerned with, Apple's down, $2. Uh-oh. If you do that every day, you're going to drive yourself crazy. What I look at is every day I'm looking at Apple's a great company. They have great future prospects, low debt. Everything I look for in a company.
Right, exactly.
So that's what it all comes down to.
There's got to be a little training going on when you get the the younger people in that I just get it $2,000. What's it look like tomorrow? And every day they're just calm down, George.
Yeah.
Go have a beer and come back in a month.
Did you ever get any pushback from your friends, or they say, nah, that's garbage? Did you ever get any of that stuff? I mean, or is everybody pretty much online, but they just don't act?
Yeah, they're pretty much online. These friends that have invested with me have been friends for a while, so they know what we do. They're very familiar with my dad, and I've had a few of them call me up and say, Chase, why did we buy this company? I'll take them through, they made great money, great income this quarter. They low debt, always come back to debt for us. As you said, the balance sheet, and we hold on to that piece of the company.
Yeah, good stuff, fantastic. Well, Chase, I think you ought to write. I think you ought to write a book. I'll write a book with you because I want to go on your coattails and make some of your money.
Yeah,
that's what that's all about. Next week, I want to have you back, and let's continue this conversation. Are we done with the? I mean, are we basically saying, look, Acorns might be good for a certain segment of the population, but probably not for millennials because it's too dangerous. You'll lose too much money, and they're not minding the shop.
Yeah, it's very difficult for me because I really firmly believe what we do is the best thing, and asset allocation, I'm not a firm believer in. So you go to your traditional broker, I don't believe in that. You go to Acorns, I don't believe in that. As I said,
I believe in me.
Yep, pretty much.
Kind of a big deal around here.
I believe in making money. So
Chase, thank you, buddy. I appreciate that. Chase Wilsey, take a look at his website there. WilseyAssetManagement.com, and we'll see you next week, buddy.
He's the little guy up front near the lettuce.
He is.
The picture was taken
that was many years ago.
2 years ago.
Good stuff.